Hey, we have a small enough group that please don't hesitate to stop and ask questions. As I said earlier, from a financial planning standpoint, one of the biggest things that people don't understand is you can have a will, you can have a trust, but all of that has to be coordinated with the registrations and the beneficiary designations. And so part of what I'm going to highlight are some examples of how things get coordinated depending on whether you have a will or a trust or beneficiary designations. And so, lovely disclosures. Our PowerPoint font didn't come through, so we look like we're in 1986, but that's okay. Still can read it. Death and taxes, the only thing that are certain in life. That and change. Freeze? Oh, like I don't know the reference. That's true. We can freeze the head. So, we've had a conversation this morning about what is estate planning. I'm going to go through some of those, but because we have talked about some of it, I'm going to go through it rather quickly. But please ask questions. Difference between wills and trusts, registration and assets and investments distribution scenarios. And then Ralph's going to go over tax considerations, actual tax returns that have to get filed depending on what you have, some specific examples and some action steps. So we have lots to get through. So when people think of estate planning, in that term, people say, when I say bring your estate planning documents, what is that? Usually it is referring to the documents Eva mentioned, your power of attorney, healthcare directive, a will or a trust. That's usually when we talk about estate planning documents, that's what we're talking about. But when you say estate planning, what you're really focused on is that big picture of arranging who will receive your assets when you die. That's usually what people think of, and so it's a topic no one wants to talk about. When I think of estate planning, it's also how do you minimize the state and federal income taxes that you have to pay? What are the health and financial affairs while you're living, like the incapacity, or maybe you're just off traveling for a year and you need someone to handle financial things for you. There's a lot of while you're living considerations. And then to account for separate property and inheritance, that's all part of your estate planning because those can be treated differently. And then we have protecting assets from spend down. We talked about Medicaid spend down, but there's also long-term care considerations. And then care for minor children. We even have several grandparents who are taking care of their grandchildren, and they have, care considerations. So it doesn't even need to be your children. How is that going to happen if you're not available? And then those with special needs, and of course the charitable giving. So all of that is when I'm talking about estate planning, I'm talking about all of those components as part of the conversation. So this also is like all the things. It's more than a will and a trust. It's, do you own a business? Do you you want to pass it down several generations, and there's generation skipping tax. There's whether you have a lot of money and set up a private foundation, or, estate planning can get very complicated very fast. All of this is involved in the components of what you have for an estate and what's important to you. So I only say this to say it's a big topic, but today we want to focus on some of the you need to have these components in place and understand how they interact, which is this. This is usually what we're talking about, and is a will and a trust, and Eva explained, those are two paths that you can take for how your assets are handled. Who needs me to talk about those? I'm going to talk about a little bit more with another slide, but questions still around will and trust? Yes.
Yes, how is it possible that you would need both a will and a trust?
Yes. So even if you have a revocable living will, revocable living trust, and you register your assets to that, your house, your investment account, things that can be registered to the trust, an attorney will also draft what's called a pour-over will. And so it's a very basic document, but you still have that will, and it says, hey, if I forgot something and it's in my individual name, it's not registered to the trust, the intent is to put it into the trust. And so there's not usually any detail of distribution in that will. It's a kind of, I forgot, put it into the trust and follow the language of the trust. So you do have a will usually, but it's very straightforward and often called what's a pour over, meaning those assets that didn't get put into the trust pour over into what the trust says. Yes?
Any chance to get a copy of all the slides?
Yes.
Okay.
Yeah. So I'm going to talk about will and trust a little bit more. Those have to be coordinated with beneficiary designations, because when I say those three things, those are talking about how assets are registered. And we're going to go into this in more detail, because how they're registered, is it in your individual name? Is it in your joint names? Is it in your individual name with a transfer on death beneficiary designation? Is it life insurance that has a beneficiary designation? Those are all telling us what happens to the asset. So the registration of something matters. And what you'll have happen is an attorney will draft you a lovely revocable living trust. It says everything you want to have, but then you don't take the next step and register everything to the name of that trust. So let's say, I actually had someone come to me recently, and they had done a trust, and then they themselves went and wrote themselves another trust because they wanted to change the language, and they just kind of followed the format of what the attorney done the first time. And so they created this second trust document, but they never changed the titling of anything. So everything they owned was in the trust, the original trust. They completely rewrote another trust, but nothing was registered to it. Everything they wanted to have happen was going to happen according to the original trust document, because the title never got changed to update to the new language. Usually you do a trust and it says Bob and Mary Smith as of January 2026. And even if you restate that completely, it says something completely different in 2023, it still holds the same original date of your first trust, but it says this is just the restatement of that, but it holds the same original date. It's just a restatement. So if you have a house, a deed, you go to the assessor's office. Usually the attorney does that. There's a process. They usually do that as part of their process, but you register it with the tax assessor's office. If you have an investment account that might have been in your individual names or your joint names, you re-register that account to the trust registration instead. So your assets have to be titled a bank account in the name of that trust for it to follow the language of the trust. Yes?
I'm moving a trust from one state to another.
Yes?
Process of how to do that right now.
Yeah.
And I'm having roadblocks in my, because I'm calling to see if, in fact, these assets are in my trust. I'm having trouble with that. Is there a procedure or something that would make it easier?
Changing the situs of the trust shouldn't have any impact in getting something registered to that trust, because really what they need is the name and the date of it. It has nothing to do where the situs. You can change the situs of a trust. It doesn't really matter. So we can talk more, but I don't see how that should be connected to anything. Uh huh. Yeah. Yeah. We can talk more, but I know what your issue is. So that's kind of detailed, but yes, let's talk more. So the registration matters. The will, trust, and beneficiary designation, the registration of your investments, that has to be coordinated for everything to ultimately flow the way you want. Probate, again, Eva's definition of the two paths, probate only happens if you have assets that pass by will and have to go through the court system to get distributed. So that's what probate comes into play. Not everyone goes through probate. There is what's called a small estate probate. If you own, is it 250? I think if you own assets less than 250, which, hardly any property is less than that these days. They haven't updated that number. There is a small estate that's a much faster, cheaper process in the state of Washington, but you pretty much don't have much that would pass, and you can do a small estate. And then the power of attorney and healthcare directives, again, those are documents that allow people to act on your behalf while you're living. And so let's say you have the same person making decisions for you on healthcare and power of attorney. Let's say it's your spouse, make it easy, or friend or whoever that's close. When you die, those documents mean nothing. Your role as power of attorney ends when that person dies. And now, if you are the executor of a will or the successor trustee in a trust, now that is your role. Your role as power of attorney ends when the person dies that you are a power of attorney for. That's no longer a thing. Now you step over to being executor or successor trustee. Yeah. It's usually called a durable power of attorney, and it is specifically for the finances. And then you will see a healthcare, which is different than an advanced directive. Advanced directive is I don't want, life support. A healthcare power of attorney is different. But usually you'll see it won't be called a financial, it'll be called a durable power of attorney, and that's usually all the finances. One thing that's important also, if you have an older power of attorney, it's really important now that it also includes language that directs what happens to your digital assets. And so whether that's your Audible account or your Apple ID or any of those things, those are really important to be, specifically you have to have it in your power of attorney that someone can get access to those things. So digital assets are a thing now to include. So these are all words you hear, but this is how they're different and how they're also related. Yeah.
One question on beneficiary designation. Is there, like, I have stock accounts that
Yes.
has a beneficiary, or IRA and stuff like that.
Yeah.
Is there any time you would want to not have a beneficiary there and that you want it to go through your will?
Rarely. It is. So it is. So I'm going to maybe answer that question on another slide, only because this comes down to some people will just say, leave it to my estate, and then it'll go according to your usually will. But the reason you don't want to just put your estate as your beneficiary designation is taxes. Taxes are handled very differently, so you ideally put people and or charity as specific beneficiaries on life insurance, IRAs, retirement accounts, not your estate. Okay. Ralph is going to talk about taxes a little bit more. I want to make sure I leave him time. All right, will and trust. We will send out these PowerPoint. You're welcome to have them. But again, will not valid. This is probably a big difference between a will and trust too. A will is not valid until you die. You can change it 6 ways to Sunday. It's whatever is valid when you die. That's what's going to happen. So a will has no authority until you die. A trust, on the other hand, is a living and breathing document that you register your assets to and that you're trustee of while you are living, and your successor trustee is actively controlling your assets while you're living. And even after death, your successor trustee is actively managing that trust. So a will only comes into a play when you have to go through probate and you've died. A living trust is actively managing, controlling what happens to your assets during life, incapacity, and after death. Okay, so this is what I was talking about. When people say, they'll say, "Oh, I want to." They'll say, "How can I say this?" They'll say, "I want to have an IRA. Is that a good investment?" And it's like, well, the IRA is not the investment, it's the registration. So when you're saying you have an IRA can own real estate, it can own a CD, it can own mutual funds. The IRA is the registration. And it just tells us what are the rules that asset has to live by. It tells you who owns it. It tells you who the beneficiary is. It tells you it's going to be taxable prior to 59 and a half. You know, like the registration only tells you how the asset is controlled. The actual investment, again, you can be invested in all kinds of different things, but those two are two different things. So you could own a home or a property as an IRA, your individual name, joint names. You can own a mutual fund in all those different things. The registration is what you have to pay attention to when you're talking about estate planning, because that registration is what tells you how that asset is going to be controlled and what happens if something happens to you. So I like to make that distinction, because that's the other thing. People get a will done or they get a living trust done, but then they don't coordinate the whole picture, and all the assets work differently. So that's the other important thing to know. What kind of registration and what it's invested in is kind of secondary to how it's registered. So if you have an asset in your individual name, I'm going to go through this fast because we haven't got to some other things. If you have individual, your only name on it, you die, well, there's nothing to say what should happen with that other than your will. So we look to your will. If you have an individual asset, whether it's a house, an investment account, you look to the will. If it's an individual with what's called a transfer on death, well, the TOD is the beneficiary, and so we pass it to who you've named as the beneficiary. So even though the asset, you're the only one controlling it while you live, it passes to the beneficiary that you've designated and doesn't go through probate. It goes directly to the beneficiary. Joint tenants, 2 people own it, joint tenants with right of survivorship. So whoever lives, the one person dies, the other person lives, the other person gets it 100%. Tenants in common is used usually when 2 people own something but they own their 50%. They're tenants in common, not joint tenants with right of survivorship. So tenants in common says, I own my 50%. And if I own my 50% as an individual and I die, you're going to look to the will to see what happens with my 50%. The other owner is still a 50% owner, but my 50% is going to go according to my will. Or if I own it as an individual with a TOD, whoever is my beneficiary is going to get my 50%, and the other 50% owner keeps their 50%. So tenants in common is a unique one that's not often used, but has reasons. Typically siblings owning something together and they want it to go to their half of the family is a common one. Trust we've talked about, and then IRAs, Roths, any type of retirement account beneficiary designation is what dictates what happens with that. A beneficiary designation supersedes anything else. So, like I said earlier, if you leave your ex-spouse as a beneficiary, you go ahead, you get married, you do whatever. If the ex-spouse is your beneficiary, they are the ones that are going to receive that account. It doesn't matter what you've done or want. Beneficiary designations supersede everything else. So let's pretend you're an individual. You have a checking and savings account. You have a house. You have an after-tax account. And you have an IRA, a Roth, and life insurance. How those are registered is how those are going to pass. So like before, let's say you have a house and a checking account. Those are in your individual name. That part of it's going to pass by your will. But let's say you have an after-tax account and it has a TOD beneficiary on it. That does not pass by your will. That passes to who the beneficiary is, the transfer on death beneficiary. And then the IRAs and life insurance, you have it designated a beneficiary. So the only thing in this case as an individual that's going to pass by a will is your house and checking and savings. Everything goes else. So you could say, I want my IRA to go to charity, and your will says, I want it to go to my 2 kids. Your will can say, I want it to go to my 2 kids, and that's where that money is going to go. Your beneficiary designations can say something completely different, and that's where that's going to go. You don't make reference to your beneficiaries in your will. Those assets pass differently, and that's the point that I want you to get when you're trying to coordinate how your estate's ultimately going to pass. Because people think, oh, I said this in my will, that's what's going to happen. I'm like, no, you have to update everything to coordinate with that. So same thing, but you have a trust. Nothing goes through probate, nothing goes through a will. It passes by the trust language. And this is a nice slide to say, okay, while you're living, you have a will, you're an individual. If you have incapacity, that's when your power of attorney comes into play. And at death, then your executor will take over and go through the estate, probate. If you have a trust, while you're living, you're the trustee of your trust. If you're incapacitated, then the successor trustee is the role that someone's playing to take over care of that. And then the successor trustee also carries everything out at death. So this is where they're similar acts, but a different document is dictating it depending on whether you have a will or trust and what the registration is of something. And then retirement accounts are also handled by a power of attorney because they can't be registered to your trust. So even if you have a trust, you need a power of attorney to have anyone change beneficiaries, make distributions on your behalf, because they might be successor of your trust, but that doesn't allow them to control any of your retirement accounts. You need a power of attorney for that. Okay, I blew through that because Ralph's got to have a few minutes.
Those pictures help, 100%.
I like pictures.
Yep.
Pictures are good. Okay, this is going to be quick. We've got a lot to go through here. The first thing that you need to know, when somebody passes on, and I'm sure everybody's experienced this, it's psychological as well as financial and everything else that you need to deal with, right? And let's see if I got this right. Nope, wrong way. There we go. Because I think there are three different hats that you wear. And those three different hats, the first one is somebody is an heir. And that heir might also be a grieving spouse or family member. And then there's the personal representative and executor, estate administrator, whatever you want to call them. That's the hard hat. That's the one that works. That's the one that you really have to prepare for. And the hard part is sometimes the person that's left is all three of these. And so on the first one, if you're just an heir, sometimes that has a psychological piece where you benefited from somebody passing on. That's not easy oftentimes. Statistics show that life insurance beneficiaries oftentimes blow the money because they don't feel good about it, even though it was meant for a good cause, right? So the next one, if you're the spouse and you have a role reversal all of a sudden, and depending on your family dynamics, some people, one person made all the food and one person paid all the bills. If one of those is gone, how do you get everything taken care of? And especially if it's the financial person that has passed, now you've got somebody that really isn't abreast with all of that, and they're grieving. And so the hard hat piece, the one that actually has to do the work, they have legal authority. They have the fiduciary duty. And it's you put on that hard hat because you can't be distributing money to your heirs, just to the kids or anybody else, just because they ask for it. Because there are legal requirements that go into that job. You're also not supposed to be a felony conviction. The personal representative's job is outlined here. You notify creditors. You marshal the assets, as Eva said. The one that's underlined here, file and pay any necessary taxes. What do you suppose happens if somebody passes on, you're the personal rep, and you just decide to start distributing the assets the way the will says you're supposed to? No advice, no attorneys, no nothing. You just say, the kids need it, they're bugging you. If you don't pay those taxes when they're due, the IRS comes back to you personally. There are hundreds of court cases where the assets have been distributed. The IRS will sue the heirs in court to get some of the money back, and they'll come after you personally. So it really is something you need to be careful with, and you make sure you get legal counsel, you take all of those steps, you marshal the assets, you get everything taken care of, and you don't listen to the heirs until the attorney blesses everything, okay? So here are the three tax returns, and there's actually maybe four depending on how this goes. Three tax returns that you need to be aware of. All of us are familiar with the 1040, right? That's what we file. If you're filing a 1040, let's say you're the personal representative, you're filing the 1040, it's January 1st through the date of death for the income in that time frame that goes on that 1040 for the decedent. If you're married, or were married, then you are married filing joint for that year, and all of your income for the whole year goes on that 1040. Does that make sense? So I do have to do a caveat. If your partner passes on and you get remarried before the end of the year, that's another topic we need to spend time on. And every time I mention that, they go, oh yeah, I'm never doing that again, right? Okay, just saying, it does happen. The 1041 is the probate estate, and it is you with your executor hat on, and you are the CEO of a little entity, of a little company, if you will. And that company's job is to administer the estate, make this all happen, and get it all taken care of legally and correctly. Pay all the taxes due, get whatever done you need to get done. Once you're finished with that 1041, and the attorney's blessed it and said, okay, you are finished legally, everything's good, then the act of distributing money to those heirs takes money out on a K-1 to those heirs, and then they use that K-1 on their personal tax return. Sometimes it's a gain, sometimes it's a loss, depending on what's going on in that estate, okay? So that's where that whole 1041 piece comes in. Then you've got a 706, and a 706 is the estate return. we're going to talk more about the actual limits here, but it's, federal government, if you're worth more than 15 million, you have to file this thing. Tax rate's 40% of everything that goes over 40%, by the way. 40% of what goes over 15 million. Did I say that right? State of Washington, it's 3 million. State of Oregon, it's $1 million. And just because you live in Washington, if you have Oregon property, if your total estate is over $1 million, Oregon wants to tax you on that piece of property in Oregon. So we've got an example of that here in a second. Even if that property is not over $1 million, exactly, good point. So the 1040 personal tax return, these are the pieces that you're supposed to take care of as the personal rep. The bottom line there is the due date is April 15th, just like a normal 1040, or October 15th if you get an extension, okay? Let's talk about a quick planning opportunity. I don't want to take too much time on this, and these are too small to actually read, but if you're married filing joint and your income is $70,000, and let's say that income is going to continue for the next year for the surviving spouse, in the married filing joint bracket, that $70,000 in income is in the 12% bracket, isn't it? If you have the same $70,000 income the next year, it's in a 22% bracket. So there is definitely some planning opportunity there for that surviving spouse to make other arrangements. Maybe take a larger our required minimum distribution. Maybe take money out of an account, an annuity or an asset or an IRA or something like that. So there's all sorts of different planning methods that you need to look at. At the same time you're grieving and working on all this stuff, you need to be planning for your future. All right? So here's the community versus non-community property issue. We talked about that a little bit at the first part. Basically, community property says when somebody passes on, you get a step up in basis to its fair market value. Does that make sense? Paid $100,000 for it, it's worth $300,000 now, it starts all over. And it's an amazing tax shelter when you pass on. And you don't want to give up that step up in basis necessarily. I mean, some chances maybe, but the idea is you want that step up, and if you give your stuff to your kids before you pass on, they're not going to get that step up when you die. They're going to pay tax on the gain. So the community property rule is everything gets that step up. The only things that don't count are an annuity, your IRAs, or a contract of sale, generally. Those are the things that do not get a step up. Everything else starts over at the current value. In a non-community property state, it's only the decedent's half that gets the step up. And so you could have some built-in gains there. Now, if you're the spouse and you still own the other half of the property and you pass on, then your half is going to go up and get a step up, and you're going to be back to no tax potentially. But it's something to consider, especially if you're moving from a community property state to a non-community property state, or vice versa. Are we good? Does that make sense? Okay.
Washington community, Oregon not.
Yes, exactly. Washington State's a community property state. Oregon is not. California is. So choose wisely which state you and actually choose your attorney that's going to help you put this together to make sure that you take advantage of all of these pieces. I mean, that's the other. All right, the 1041, we talked a little bit about that one. That's the one where you're the CEO. You got to take care of this thing. Notice the bottom piece of this is the due date is April 15th or October 15th, if extended, or 3.5 months after the fiscal year end. And so here's another planning opportunity. All right, so if you have the 1040, you know what those dates are. You fill out the 1040 for the year that they passed on, and now you're the administrator of the estate and you're doing the 1041. You can say, look, they passed on in June. I want this to go from June till December 31st, and I want to file a 1041, and you can do that. But if the estate's not finished, then you're going to file another 1041 the next year, because your estate's not finished, right? And you might have to file another one. I mean, you might have a couple of years at this, depending on how long it takes to get these assets done. You can choose a fiscal year filing and say, hey, they passed on in June, I want to go to June of the next year, and then the tax return is due 3.5 months after that. So do you see how that tax planning might throw some of that income that's on that 1041 off to the next year for the heirs? And that can be a good planning move. It's a great tool. It's something to look for, okay? The 706 estate tax, in 2026, it's $15 million for the federal government. If your estate's worth more than $15 million, you have to file a 706. It's due 9 months after date of passing. There is an extension of 6 months you can get. The 706 is a snapshot of everything you own or everything the decedent owned on their date of passing. So you need appraisals on the house. You need appraisals on your rentals. You need the brokerage firms, the financial planners. Everybody has to give you the exact value. And there's an actual formula that goes along with how do you value stocks and bonds and things like that. So they have to give you this valuation for exactly that date of passing. And it's averaged if it's on a weekend. I mean, it's very specific. On that 706, if you have to file one, you list every single stock, every single bond, every single asset. You put the appraisal with it. I mean, oftentimes when you send these in, they are literally a 1,000-page 3-ring binder that gets sent in for some of these. And they're starting to do them electronically, but that's the detail level that they go through this. The estates that are worth less than $15 million, people say, well, I don't want to file that. I'm not worth $15 million. And then the spouse says, I'm never going to be worth $15 million, so I shouldn't have to file this. But there's a thing called a DSU, which is a deceased spouse unused exemption. That $15 million belongs to you. If you pass on, your spouse can say, I want to take his $15 million because he didn't use it all. I want to take his and apply it to mine. And so you file that 706 for the federal government on an abbreviated format, doing a DSU, to carry that exemption forward to you. Because you say, well, I'm not worth $15 million, but not too far back in history here, in 2003, that was an estate worth $1 million. I mean, what is that, a house and a 401k these days, right? I mean, you know? That number has been all across the board. So you want to file that DSU, carry it forward, make sure you can capture that if something happens, and this goes back the other direction from 15 million down to 1 million or whatever they do. Does that make sense? Is this fun?
File the DSU on the first decedents.
Yes, on the first decedents when they pass, and right. So if one person passes, they've got their 15 million, they didn't use it, you carry that 15 million forward to you, you pass on, now your estate can be worth 30 million and not pay tax. And that could be important, because if you don't do that and they decrease the estate exemption down to $1 million and you've got 3 million, all of a sudden you're in a 40% tax bracket, or 45 back in the day, 49 back in that one, right? It's very expensive if you don't do the planning on these. The estate tax return summary, this kind of just goes through the ideas we've just talked about, and it hits some of those topics. Washington state tax for their $3 million, we talked about that part, right? 15 million is the federal limit, 3 million is the state of Washington. If you have more than 3 million in assets when you die, then you file a 706 tax return for the state of Washington. 2 things you need to know. First of all, there's an unlimited marital deduction. If your spouse is the person that gets all of your stuff, then you can be worth 30 million, 300 million, it doesn't matter. On that passing, no tax. You still have to file, but no tax. It's when that second spouse passes, if they've got more than the 3 million, there will be a tax unless they've done other planning. You see where this gets a little bit complicated and you really have to keep up on it? So here's the example. Here's an Oregon house example. If your estate is worth 3.1 total, 3.1 million total, right? Am I going to have to file a 706 federally because I'm over 15 million? No. Am I going to have to file in Oregon because I'm over $1 million? Yes, exactly. Thank you. Because that's the issue. You think, my place is only worth $500,000 in Oregon, but they don't care because your total estate is worth more than that. And so you're going to end up paying, the calculation there for you, you're going to end up paying $34,677, or your heirs will, on that house in Oregon. And you still have some to pay in Washington. And that's assuming it wasn't the spouse that was getting it, because that's an unlimited marital deduction, okay? All right, so here's another example of an idea. This is just a concept. This is an idea. I'm not saying everybody should run out and do this. You need legal counsel. Is that enough disclosures? So one of the things that people do is, let's say you have a $6 million estate. If that all goes to the one spouse, there's no inheritance tax because unlimited marital deduction says you don't have to pay tax. And then it all goes to the beneficiaries when it's done. When that second spouse passes with $6 million, that's a $500,000 tax bill to the state of Washington. See where that comes in? Because now they died with $6 million. The state needs the money, yes. The state's broke, apparently. What attorneys will have you do oftentimes is split that estate up. They'll say, well, we got $6 million, let's put $3 million over here in a trust. And that trust, I mean, they name it all sorts of things, bypass, family trust, marital trust, whatever you want to call it. It means the money was segregated off onto a trust. And then they'll generally make the annual income send out to the spouse for their care and welfare and whatever they need. And then when the spouse passes on, they're worth $3 million, which doesn't have any tax. And the heirs get both sides. They get what's left of the spouse's money, and they get what was in the trust. The difference here is that the money that went into that trust does not get a step up in basis on the second passing, right? Because it's not owned by the decedent, the person that died second, okay? And so that is really the critical piece to that whole game, but they'll do that all the time. And that trust then has a 1041 tax return every year for the rest of your life. And it's going to cost you a few bucks to make that tax return happen, but it's a cheaper cost than paying the estate tax if you're over the limits. And this
Can you share about the trust when you give to family, a remainder comes to ministry?
So yes, there's charitable remainder trusts where you put the money in, and then whatever's left when you're done goes to the charity, and it's a tax deductible event that we see used quite often for people that have more than the limits. It's a great way to. Exactly. Thank you. The estate administration, ongoing trust, the action steps really. You've got to talk about this. I really applaud these guys for doing this because you've got to do these things up front. If you trust any government organization to figure out how you're going to pay the lowest tax and how to get the stuff to the heirs you want and how to take care of you if you're incapacitated, then you don't need to do any of this. But if you want to take care of it and control it and make sure it goes where you want it to go and takes care of you properly, you've got to have these discussions. And so I know we're right at time. Do you guys want to stay for a couple minutes and do questions and answers? Are we good with that? Okay, so we'll take questions. Got another one over here.
Ask away. Yes. Not necessarily. So if you have both people have passed and the assets are getting distributed, not everything is usually converted to cash. It could be that the house someone wants, and so there might be enough money plus a house that one person takes the house and other people take investments. Usually investments, if there has been a step up in cost basis, you can sell everything and liquidate. But usually also, let's say there's money in a trust, when that second person dies, you can't just distribute the money and you can't just trade right away. And so there is usually some gain. So usually we end up distributing shares of things and then people can make individual decisions. Sometimes it's converted to cash, but I'd say more often than not, it's not converted to cash. Ron?
I have a specific example in Oregon, a fractional timeshare. It's not really timeshare, it's just fractional property that we own with 12 other people. Is that treated the same way as regular Oregon real estate?
Yeah.
First of all, you take that snapshot for the 706 to value it. Ideally, you get an appraisal because they're going to give you the best valuation, and that gives you the step up in basis later and all of those pieces. But yes, that's going to be treated the same way in Oregon.
But it's just going to be based on my fractional ownership.
Yes,
Correct.
correct.
Yes.
So sorry, let me stop that for just a second too, because yes, that's true. It's based on your fractional ownership, but if your estate in the state of Washington is worth more than $1 million, then Oregon's going to want to tax that, whatever it is.
Just like his example.
Just like the example. So even if your fractional ownership is only $100,000, if your estate is worth more than $1 million total everywhere, Oregon says they want you to pay tax to them.
On the basis of the
On the value of what you have in Oregon, that 100,000 in that example. Yeah. Thank you.
Yes.
I've seen a couple of these, and it's called a bankrupt estate. And so before you take on the role of executor, or even if it's listed in the will, you don't have to accept that role. If you're listed and you know that there's no assets to deal with and it's all debt, you might not want to take that job. You want to go to the attorneys first and say, okay, here's the deal, here's the assets, here's the liabilities, what do we want to do? We had one where they had been in a care facility for a long time. The kids didn't really care about anybody, and squatters moved into their house. And so then they pass on, and then one of the children is now the executor, and he's going, well, what do I do? I mean, this house is pretty much worthless. They've destroyed it. And the attorney said, don't take that job. Let it go back into foreclosure. Let the state take it, whatever.
The other question I haven't seen this for a while is some assets are protected from creditors. And so if maybe you have something where you're the beneficiary, that has nothing to do with the probatable estate. And they would have to come after assets, which is unlikely to happen in a lot of cases, especially with medical. So they might have some assets that can still go to beneficiaries, but just keep in mind that's a separate. When they die.
So they're going to list you in the will. They're going to say, take the most responsible, good-looking, best son ever, and put him on there, right? There you go. But you don't have to go and accept it. Oftentimes they'll put if they want to or not. You can deny. You can, yeah.
Yes. The will comes into effect, and so whoever's named comes into effect.
And by you get to choose. I don't want that job.
Yes. Sometimes. I think so, I will say, I should caveat, I think that sometimes, because you might change your mind. If you have a kind of straightforward situation, you know, a few kids and everyone theoretically gets along, I think saying what the intent is fine. I think it's also super important. Like, I have clients who are going to give a fair amount of their estate to charity, and I think it's important they tell their kids the kids aren't getting everything, so that they hear that they aren't getting everything. Or kind of the fair doesn't mean equal, that you're giving more assets to someone to take care of them, or whatever the reason is, that is your wish, or that you're not giving assets to someone because of certain reasons. And again, that really should be stated in your will, that you are specifically not including someone, because that's the only way for them to really not contest. So I also am not a fan of people telling them how much you have. So let's say you even have 2 adult children, they're great, everything's fine. They don't need to know how much money you have, but I do think just assuring them, we have enough to take care of ourselves. You know, if you're too young, you don't really want to share that right now, but just reassuring them, you've done your planning, our intent is this. You don't have to share the dollar amount.
Sounds good. Okay, so
I have to say, your kids do not have the same perspective as you do. I mean, not even close. And that's, I think, the reason I think it's important to express what your wishes are. And even if you don't want to have that conversation, I do encourage you to type it or write it. I don't care how you do it, but to put something in writing so that they heard it from you. Sometimes I'm the interpreter between generations, and I'm fine doing that, but it still means more coming from the parent ultimately. So I do think it's important that in some fashion you write it down.
okay, I think we're a few minutes past time, and lunch is probably on its way here, so we'll release you to go do that. If you have questions, yep.
Thank you very